Hello everyone, welcome to this video. My name is Sahil and this is Divya.
Hello everyone.
We are students of BSc Honors in Data Science and Artificial Intelligence at Indian Institute of Technology, Guwahati. And in this video, we will be presenting our project titled Portfolio Analysis and Optimization, which has been carried out as part of our 7th trimester academic curriculum. So now let us take a quick look at our agenda. We will begin with an introduction where we briefly explain the concept of portfolio optimization. Next, we will discuss the problem context and objectives, outlining the key challenges and goals of our project. After that, we will cover the dataset and pre-processing techniques used, including how the data was collected and prepared for analysis. We'll then move on to the methodology and portfolio optimization, where we explain the techniques and models used. This will be followed by results and analysis, where we present the outcomes of our project. We will also include a discussion to highlight key insights and observations. And we'll then see the limitations and future scope of the project. And finally, conclude with the conclusion. Move to the introduction. So portfolio optimization is a very fundamental concept in investment management, which focus on combining multiple assets in a manner that gives good returns while keeping the risk under control. So to do this, we study past financial data and decide how to distribute our investments across different assets. And this helps reduce the impact of market ups and downs. And one common approach used here is modern portfolio theory, which was introduced by Harry Markowitz in 1951. So it is a quantitative framework which helps us create a diversified portfolio and understand the balance between risk and return. This way, investors can make better and more informed decisions. Move to the problem context and objectives. So the first thing comes in portfolio, like portfolio selections. And it means that deciding how to invest money across different assets. And this is not easy because market is uncertain. So investors always face a trade-off between return and risk. Like higher returns usually come with higher risk. Also, if investments are not properly diversified, the portfolio can become inefficient and unstable. Now coming to the objectives. First, we aim to analyze the historical risk and return of selected stocks. And second, we evaluate diversification by studying how different assets are related using correlation. Finally, we construct optimal portfolios using modern portfolio theory. Move to the data sets and pre-processing. We used daily adjusted closing price of 5 selected Indian stocks such as HCL Tech and Axis Bank, etc. We also included the Nifty 50 index as a benchmark to compare overall market performance. And the data covers the last 5 years and was collected from Yahoo Finance. Before analysis, we perform some pre-processing steps. First, we handle missing values by the forward fill method, also outliers detected, and then we calculated the daily logarithmic returns from the price data. And here we use log returns because they are easier to work and give more consistent results over the continuous data rather than simple returns. And we then annualize the returns and covariance metrics and assumed 252 trading days in a year. Divya will now take you through the next part.
Methodology and portfolio optimization. Let's walk through the methodology behind our portfolio optimization in a simpler way. We begin with the basics, estimating returns and understanding risk. To gauge returns, we use each stock's historical log returns, which offer a cleaner view of past performance. For risk, we do not just look at individual volatility, we also examine how the stocks move together. The variance covariance matrix helps capture these relationships across all asset pairs. With these inputs, we run portfolio optimization, testing different combinations to find the best risk return mix. One key outcome is the global minimum variance portfolio, the red cross in the graph, which represents the lowest risk portfolio possible, ideal for conservative or stability focused investors. We also identify the tangency portfolio, the purple star, which delivers the highest return per unit of risk by maximizing the Sharpe ratio. It sits at the point where the efficient frontier meets the capital market line, making it the most efficient portfolio. To keep the analysis realistic, we apply two constraints. Weights must sum to 1, and short selling is not allowed, reflecting practical long-only investment strategies. Let's focus on the graph. These small blue dots show randomly generated portfolios. Each dot is one unique mix of stock weights. Together, they illustrate the full range of possible risk-return outcomes and what typical portfolios look like before optimization. The curved blue line is the efficient frontier, representing the best possible portfolios. For any risk level, portfolios on this line deliver the highest return. The dashed orange line is the CML, capital market line, which shows the highest expected return for a given risk when investors can borrow or lend at the risk-free rate. Portfolios below the CML are inefficient. The orange diamonds are the individual stocks, most of which lie below the efficient frontier, highlighting how diversification improves risk-adjusted performance. The red square marks the equal weight portfolio, a simple diversification benchmark. It is rarely optimal, but usually better than holding single stocks. The GMEP and tangency portfolio mark the lowest risk and the most efficient points on the chart, demonstrating the impact of mathematical optimization. Next, we will move into the results and performance analysis. In this section, we look at the key results from our portfolio analysis and what they reveal about asset behavior and portfolio efficiency. On the right, the correlation matrix shows how closely the assets move together. The diagonal is 1 simply because every stock is perfectly correlated with itself. Most correlations fall between 0.15 and 0.33 range, which you can also see from the lighter sets in the heat map. These low values mean the assets do not move in sync, creating strong diversification benefits. On the left, the efficient frontier illustrates how optimization makes use of this diversification to find the best risk-return combinations. When compared with simple strategies like equal weight or benchmark portfolios, the optimized portfolios consistently deliver better risk-adjusted performance. The tangency portfolio stands out with the highest Sharpe ratio, meaning it offers the best return for each unit of risk and is the most attractive choice for performance-focused investors. The results show that low correlations, thoughtful asset selection, and optimization techniques lead to stronger, more efficient portfolios. Next is the discussion and key insight. This slide brings together the key insight from our portfolio analysis. Diversification clearly shows its values. Combining assets that don't move together reduces risk without sacrificing much return. The GMVP suits risk-averse investors, offering steady, low volatility performance. The tangency portfolio is ideal for those seeking higher returns. It delivers the strongest risk-adjusted performance and consistently outperforms both the benchmark and equal weight approach. These outcomes are based on historical data and modeling assumption, so results may change as market evolve. Overall, the analysis shows how choosing the right asset mix and using optimization technique can boost returns while keeping risk controlled. Now Sahil will take you through the code base of this project.
Thank you, Divya. Allow me a minute. I hope you are able to see the code base of the project.
Yes.
Okay. Okay, so So this project is organized into three main components: a config folder, a SRC folder, and a Jupyter notebook for analysis and experimentation. First, we see the config file, and this file contains all configurable inputs like a list of stock tickers, benchmark index, and time horizon in years. Next, we see source folder, which contains two files, data ingestion and portfolio core. So in the ingestion file, we fetch historical price data and clean it before analysis, and we handle missing values and any outliers detected, and then we pass this data to the main file, which is portfolio core. This is the core file of this project. Here we do all the mathematical calculations like return calculation, risk matrix, covariance metric computation, and portfolio optimization logic. Then we go to our main notebook. In the first cell, we import all the necessary modules and packages. Then we describe our data. Then we visualize it on the plot. Then we see the expected annual return and annual volatility for average stocks. We can see that Bharti has the highest annual return, and HCL and Axis Bank has the highest annual volatility. Then we see the correlation matrix, and here we can see that none of the stocks are correlated, even 0.5. So we can see the benefit of diversification in this portfolio. Next, we see the portfolio optimization summary plot, which is already discussed from the slide. Move to the next. And here we see weight allocation for every portfolio. So for equal weight portfolio, we can see the return, volatility, and Sharpe ratio is mentioned for the same global minimum portfolio and the tendency portfolio. The weight allocation and the return, volatility, and Sharpe ratios is there. Then we compare this with benchmark. We can see that if investor goes through the benchmark, they'll only get on around 11% of return with a 13% of risk, which gives this Sharpe ratio of half, which is not good if we compare to other portfolios like equal weight, GMVP, and tendency portfolio. If we do just diversification, like assign equal weight to every portfolio, we can achieve higher performance from the benchmark. And if we do a bit of optimization, then we'll get GMVP and tendency portfolio, which gives more, even better for the best results. Then we see the plot for growth of 1 unit of investment. If we go through by different portfolios, then how much we will get from the past 5 years. Then we see security market line. So here we can see that the stocks which lies above this line, they are usually offering higher return than their expected risk. So they are potentially undervalued stocks. So it's good to invest in those stocks. And the stocks lying below this line are overvalued stocks. So it's good to avoid these stocks. Next, we see the stocks by highest beta. So the stocks with greater than 1, they are more riskier than the market. So it's good to not invest in those stocks as well. With this, we move back to our slides, and Divya will continue.
Next is limitation and future work. Before concluding, it's important to acknowledge the limitations of our analysis. The model has a few limitations. It relies on historical data and fixed assumptions, so it may miss sudden market shifts. It also ignores transaction cost and taxes, which means real world results could differ. And it assumes instant rebalancing, something that rarely happens in practice. Looking forward, there are several ways to strengthen the analysis. Adding transaction cost and practical constant would make the results more realistic. Expanding the asset universe would give the optimization more depth. Exploring dynamic or multi-period models would also help capture how portfolios adjust as markets changes. Together, these improvements would make the model more realistic, resilient, and aligned with the real-world portfolio management. Next up is the conclusion. To conclude, this project shows how modern portfolio theory can be applied effectively using real market data. Through quantitative optimization, we can significantly improve a portfolio's risk-return profile compared to simple or naive strategies. The optimized portfolios outperform both equal weight and benchmark-based approaches, demonstrating how mathematical models meaningfully enhance portfolio construction. Overall, the framework provides a systematic, data-driven foundation for making more informed and objective investment decisions. That's all about our presentation. Thank you.
For detailed information regarding this project, please do check out our GitHub repo. The link is provided. And thank you for bearing with us.